Welcome to our today's feature presentation. Let the chart tell when to buy or sell. We will cover the following topics today. What is the basis of your trading decisions and how do you limit your risk? That number one. Second, we want to explore how decision making and selected trading strategies can bring the odds in your favor when you determine at the beginning of the trade where's your entry point, where's your exit, and where to place the stop and bring those in relation. And very important, if you don't know why to trade, if you just do it by chance, you will never reach profitability, period. We are for more than 10 years in the trading education business, and we can say trading is not easy, but it's learnable. My name is Thomas Barman. I'm your presenter today, and I'm the owner and inventor of the concept of never lost trading. Upfront, never lost trading is not a promise to never lose a trade. It's a concept to repair the trade, so trade repair instead of stop taking, but never stop loss trading was a little bit lengthy. I'm not here as a broker, dealer, or financial advisor, but as a trader and educator, and I want to share how we go to market. As a trader, you have choices. What instruments do you want to invest or trade with? The difference between trading and investing is only the period of time that you hold it. We talk about investing if you hold for weeks or months, and we talk about trading if you hold just in a day, open and close the same day, or if you swing trade and hold for a couple of days. So there's about 1,000 well tradable stocks with an amount of transactions above 1 million a day, and they have very narrow bid-ask spread, so therefore that's a lot of choice you can take. On the other hand, stock options are relative super instruments for limiting your risk. There's about 400 well tradable stock options. The others, there's more available. They have a wide bid-ask spread, very little volume, and that's dangerous. On the side of the futures, for retail traders, there is about 20 well tradable futures to select from, and the same accounts for forex pairs. So you have a choice, but on the other hand, there's also a knowledge base and certain skills involved to trade those instruments successfully, and we want to dive a little deeper into that now. We put a little chart together for making clear what we want to say with the dimensions of trading. So you see here certain sizes of bubbles, so the size of the bubble is in reference to the number of the transactions, and then you see two axes, the knowledge and the predictability of the underlying asset drawn in respect to each other. And there you see, okay, the way we appraise it here, stock trading doesn't have to have the highest knowledge, but has a good predictability. So that's the easiest choice of all of those. You start coming to options trading, you'll need a lot of dimensions of a knowledge base to be able to trade those right, because you have time decaying products. So even if you are right in direction, if you didn't pick the right option, you still might not make money. And futures and forex, they're somewhere in between, because there's certain transactions that make them a little more complicated, or on the other hand, the risk of trading one or two of those over a longer period of time entails a much higher risk. What makes stock trading a little more attractive for a beginning trader is the readily available stock at penny bid-ask spreads, and you can just buy one or two, so you can limit your risk in that trade until you have it right. Different when you, for example, trade a futures contract. The CME imposes a maintenance margin. The maintenance margin says this is the highest risk if you trade that instrument, like for example the E-mini S&P 500 contract, for the future. And if you trade that, you have to have $12,500 in your account, because that should cover at the moment the highest potential exposed risk to that trade. So you see, there is certain ways of doing it. There is not one over the other. You need a knowledge base in all those assets, but stocks are, by our appraisal, the easiest to trade, because you can limit your risk very much for buying one or two shares, and with our today's prices where you pay close to no commission, that's a nice entry. However, there is a ticket attached to that. SEC regulations, so for example, if you want to short stocks, first of all, they have to be available to be borrowed from your broker. If you want to short them, then you have to have more than $25,000 in your account. It cannot be shorted, for example, in an IRA or cash account. So there's to every of those account bases a knowledge base and a skill base, and this is what we train people on, and we want to share more of this. An essential skill for retail traders is to limit the risk in a trade. This is where a lot of retail traders fall short. Why? They just barely know how to limit the risk of a trade, and with that they face tremendous drawdowns. To prevent that, I want to give you in an overview the different ways of how you can limit your risk, and sure, there's a little more to that I cannot show here in that video, but at least want to give you an overview of what to do and how to go into the market with risk limiting strategies. In this matrix, we put together ideas of how to limit the risk for certain of the asset classes. Here, stocks, options, futures, and forex. So for example, for stocks, day trading is a good way for limiting your risk, because stocks don't gap usually intraday. That would be a total exception. The big threat is an overnight gap, in the direction that you don't plan, because you operate basically with a market stop, and if you leave it open, then you'll get stopped at the price when the trade restarts, and that might be very unfavorable. However, if you combine stock with options and you trade this way, you can definitely limit your risk. The same if you just trade the options, because when you buy puts or calls or invest in verticals, the max you can lose is the premium you paid, and with that you are not exposed to the overnight risk, but you are dealing with time decaying underlyings, which if you're not right, the investment will just go away and you'll make no profit. When we go over to futures, as long as you day trade them, gaps or rush moves are an exception. They happen at certain news points, and you have to be aware of those. We always post them in our Telegram channel, or you find them also on our website under the tab News. And so then you'll need to be prepared that at certain points in the day, at certain times, something is happening, driving prices up and down, and you don't necessarily want to be involved right in front of those events. You can also trade puts, calls, or verticals on futures, and they are a great instrument because they limit your overnight risk, and you can still participate in the underlying price move. Forex, by the partitioning of micro accounts, and that you can have a broker that allows you fractional investments, has a very, very good opportunity for limiting your risk. There is, as I showed, also a limited number of well tradable forex pairs. However, if you have central bank decisions, they might throw your asset price left or right, in particular if you hold a little longer. So each of those strategies has opportunities, but important is whatever you do, trade with risk limiting strategies. By combining predictability, knowledge, and risk limiting, you see there's a matrix where, for example, for stocks, predictability is kind of high, so that's doable. Knowledge, medium, you need to know about your underlying, but it's learnable. Risk limiting, there's plenty of opportunities if you trade stock with narrow bid-ask spreads, high volumes on the option side. When you combine options and stocks, you go to the market with risk limit. On the option side, so there is a lot of possibility you can do too, but you have to pick the right underlying and the right option. And in futures trading, it is medium high, risk limiting high. Why? Because you have basically a 24-hour market, and in the 24-hour market there is certain point in times when you can go in and out if you don't want to take the overnight risk. And so there is ways of closing at the end of the day 4:15 East. You are open position and reopening it at 6, and then you are never exposed to the high CME maintenance margin and to the high risk of a potential gap. The same accounts for Forex. You have kind of 24-hour markets, 5 to 6 days a week, so that offers a lot of opportunities. But what do we do with all that? How can it be put on a chart so that you as a retail trader have the opportunity for letting the chart tell when to buy or sell? Let us pick some chart examples. Where we can demonstrate how you can work with clear-cut entries, exits, and stops on shorter term trades. So that will be intraday trades and also on swing trades. So first of all, we look at Apple, and we use a day trading chart, which we picked, and we use a swing trading chart. What you will see from our indicators is the never lost trading trend catching indicator and the timeless indicator. I'll refer to the details. The chart you see for Apple is a day trading chart. Yeah, the important part to it, we call it timeless, because each of those bars is not constructed by time, it's constructed by a price move. And then you see at crucial points, indicators will map out where is an opportunity to here short the stock and how far is it supposed to go until it reaches target, and what do we do then? We'll take the trade off and we'll do that again. You see here that indicator came out and did it. What you are looking at is here an entire trading day between 9:30 and 4, and you see multiple opportunities, and we take them pure mechanically. Yeah, so in the mentorship we work together with, I'll show you also how that can be taken into consideration, which of the opportunities are a little more probable than others. But here on the first attempt I just show you mechanical, this in win. We do not enter at an exit candle. So you see, for example, here that was the entry point, there was the stop, the red crossbar. When we came to target, we disregarded all the other signals that were on the way. Here an opposite facing, here two directional, same directional facing, will take them out of the cohesion. And also we have one thing which we call the 3 spool level. So when the price move went for a 3 spool from a central signal, like here, we stop our trading. Yeah, at the 3 spool level, we're not going to enter directional trade in that direction because nothing goes forever. Then you see here price turnaround here in the afternoon, 12:30 East, and the signal comes to target. We disregard the second on it and we bring it home. And we'll do that again here, but this was a loss. That happens. We are high probability. We are not always winning. Yeah, but then on the next opportunity, we again we're able to bring our trade to target. However, we don't enter at the exit candle. This is where we got stopped, so therefore you see no winning trade here. We would have not forgone that trade, but then in the continuation of the afternoon we had several opportunities to make the day very positive by following a clear-cut concept. So we formulate entry levels, we formulate exits, where is the target, where do we close the trade, and we formulate by the system with the red crossbar where the stop is. This way you come to high probability trading in a stock like Apple intraday, but I'll also show you now a swing trading example where we do the same. We partition the price move and we disregard time with the Never Lost Trading timeless chart. Our indicators surely also work on time-based chart, and this is why I choose here a daily chart, yeah, with the trend catching and timeless indicators on them. Yeah, they also work time-based. And you see here, for example, first signal came here, short Apple here. If the price threshold that is formulated out here, 174.64, is surpassed in the price movement of the next candle, that was the fact, so we enter a trade. There was our exit, and so therefore we leave it. When here, for that example, signal is not confirmed, yeah, the price movement of the next candle didn't surpass the threshold of 177.18, no trade will be initiated. This way you can work with buy stop, sell stop orders. And so for the next day, for example, if you wanted to go short with Apple, yeah, you formulate your sell stop, or you trade with a put strategy that we can share with you, and you enter short, and the moment your target is reached, you get into the trade. And then we can do that again, because you know we don't enter at the exit candle, but in the candle right after, mechanically we'll go for the next trade. And if we cannot short the stock because it might not be available, then we work with a put strategy for partaking in a downside movement of an asset. On trades that are not confirmed, yeah, you saw here price threshold not confirmed, price threshold not confirmed, not confirmed, not confirmed, so then we don't have a trade. And here that was February 10 when I made that chart. There we also had no confirmation because the next day we opened lower. So this is how it works. Yeah, so the system works out high probable price turning points, gives you your entry threshold, gives you your target, and also provides you the stop, and you can follow the underlying price move either within shorting or going long in the asset, or within learning the options trading strategies that we share in our mentorships. In the next example, we pick a timeless chart for the E-mini S&P 500 futures contract and show you the principle that repeats itself. Here's the chart. So all of these bars are purely price-based initiated. You see the afternoon of February 4 that we picked here, and you see first signal here, buy threshold, surpassed in the next candle. There was the exit. We wouldn't enter at the exit candle, but on the next, yeah, and we bring it home. Then we have the opposite facing signals coming to target a couple of times. We again don't enter at the exit candle, but right after. And this is what our system's going to give you. High probable trades at key price turning points with repetitive action. So you see multiple times in a development of a trend, it gives you opportunities, and we share with you money management and how to capture those and how to make weekly and monthly budgets, turning yourself into profitable traders. Back to a time-based chart, you see a daily chart here for the E-mini S&P 500 futures contract, and signals and actions repeats itself. Yeah, so you saw here, there was the entry threshold, there was the target. When we came to target, we'll start the trade, and here you see no trade, because you see these boxes on the chart. This is the never loss trading box indicator that tells you where high probable price accumulation points are, and we do not trade against them. So here on that candle, no entry, because there is a barrier that we have to go through, and we didn't do that here on that candle, so no trade. While when we break out of the price containment, we enter into trades here to the downside, and we'll do that again on the upside trade. And here, for example, we had a price short signal not confirmed, so therefore we wouldn't trade it, but this one was confirmed, and we'll see in a continuation of this trade of where it ends. We are high probability trading, and you see we have more winners than losers here on the charts, and we had very high accuracy in the last days for a lot of these instruments, and we want to invite you being part of this. For our Forex example, we choose the Euro US dollar pair, and we also gonna look timeless and time-based. Here we take a daily chart and we take a timeless chart. Timeless is fractioning the price move into petitions. That gives you always the opportunity that you trade at favorable risk-reward relations at key price turning points. So that's the big advantage, but it works time-based too, what our indicators say. Here you see in the timeless chart, no trade again, like we see against that barrier that cuts the target short, and this is exactly where the price bounced. You might just not know it, but this indicator helps you to make that decision. Don't trade me, because there is a barrier on the bottom that might never let the price reach that target. However, when we break out of the containment, we follow through and we bring this home, and we'll do that again on a downside turn and again to the downside. This one would have been a loser. Yeah, absolutely, that happens, part of trading, but then you see on the chart we have more winners than losers, and that is what we propagate. High probability trading at price turning points. There's rules to learn, and we work individually only, and there is a lot to learn for trading, and we share that with you because we have many decades of experience on the one hand, but also more than 10 years in business within educating people how to trade and invest. Now you see the same happening on a daily chart. Yeah, on the first we wrote win. Why? We would only trade that trade here to the border of the box. Did it go deeper? Absolutely, but we would not have known, and we comply to our rules. It was still a favorable and a profitable trade, and then we continued on that to the way down and to the way up. So you see at any instance the system will tell where is a price turning point. There is a price threshold to be surpassed. When it's surpassed, it formulates a target. Does it sometimes go higher? Yes, but it's not going to matter. If you can make these trades at those key price turning points, it'll make a big change to your trading. And with the risk limiting strategies that we share with you, you in business for striving for constant income from the financial markets. If you want to be part of this, call our office or write an email to contact@neverlosstrading.com, subject demo, and we'll get together with you and look jointly at the assets that you like to trade for timeless and time-based charts, and we can add up the winners and losers, and you see we will come to high probability trading. There is a lot to learn in trading, and we want to share with you how to find price move opportunities at crucial price turning points, how to limit your risk, where to find good assets to trade, how to repair trades when they go wrong, and how much money to hold back for potential repair or hedging functions. And we build together with you a business plan for trading success. So that means an action plan, when to trade, when not, which assets you want to focus on and how to trade those, and also how frequent and for what minimum price moves to do so, and what's the expected weekly or monthly return out of this for any account. If it's an IRA account, if it's a day trading account, we have strategies that fit your scope, and we support you with those out of more than 10 years in the trading and education business. We teach and coach one-on-one only, and we'll also do that on weekends, working with you at what you want to reach. And so if you're ready for this, write us an email to contact@neverlosttrading.com. If you want to read more, there is an address, neverlosttrading@wordpress.com, where you can see more of our publications, but feel free to be invited to a free consulting hour with us, where we can find out what can work for you and how we want to make a difference in your trading. Thank you very much for your attention, and we are looking forward to hearing back from you. Bye-bye.